Hi, folks. My name is James Griffin. I'm a partner here at Occidental Asset Management located in Central Florida. And today we're going to talk a little bit about last week's events that have come to fruition here in the Middle East and the implications we see of the Iranian strikes there on U.S. stocks. Obviously, some quick disclosures here. Information here is informational, educational, and although history may rhyme, it doesn't always repeat itself. So we'll get into it. So today we'll have three main takeaways to anchor the discussion. First, crisis-driven sell-offs are often recouped within weeks when there's no lasting economic fallout. Second, inflation is a key risk because persistent inflation rebound can remove a core driver of this bull market, and it can complicate Federal Reserve policy. Lastly, uncertainty can weigh on technicals, but the weight of the evidence still favors stocks for now. We'll get more into that here in a little bit. So slide 4, context. So right after the strikes, investors focused on immediate commodity and risk implications. There's, high impact to aluminum and oil and gas in the Middle East. This deck stakes looks one step deeper at what the conflict could mean for the broader U.S. equity markets. The baseline view is that barring a prolonged disruption of global oil supplies, the conflict is unlikely to end the 3.5-year cyclical bull market by itself. Instead, it adds to the list of risk as we move into the middle of midterms, which tends to be the most volatile out of the 4-year cycle. So implication 1, knee-jerk reactions usually fade. So Net Research is our preferred research provider for our firm, and they went back and tracked 59 crisis events since 1907. And during that event window, the market tended to decline with an average drop of 7% and a median of 3%. But once the crisis passed, the market has typically recovered within a few months. Are crises that damage the economy, like Bear Stearns in 2008 or the Arab oil embargo in 1973. The key question is not the headline. The key question is whether this creates durable economic impairment. Implication 2, inflation is a key risk to watch. One concern was that the market was already vulnerable to a typical mid-term year correction, and the conflict could be a catalyst if it flips otherwise bullish indicators bearish. Headline CPI has been in a downward trajectory since August 2022, and that disinflation has been a primary driver of the cyclical bull market. As you can see in slide 7, the key inflation signal has room for noise. This year-over-year CPI is 0.36 percentage points below its 6-month average. It would need to rise 0.6% points above that 6-point average to trigger a bearish signal. So translation, a short-term oil spike does not automatically mean a regime shift. The risk is persistent and whether higher energy prices leak into broader inflation and expectations. So implication 3, this table here on the right gives you a picture of Fed chairpersons as well as data surrounding their entry. So the Federal Reserve complexity rises. So markets obviously don't like uncertainty. A new Fed chair adds another layer to that. Some chairs had smooth starts, others face crises. The data show a wide range of outcomes, but the typical experience includes meaningful drawdowns early in a chair transition. So as it relates to Fed chair changes, this table summarizes it. The median maximum drawdown in the first 6 months is negative 9.8%, with an average at negative 14.8%. Investors have expected a Warsh-led Fed to be dovish early on, at least on the policy rate. A protracted war in the Middle East could delay the next phase of the easing cycle. This practical takeaway is that even if growth holds up, the market could struggle when policy rises. In other words, rate difficult if inflation starts to pick up. Implication four. So, rotation confusion can become a headwind. The defining characteristic of 2026 year to date is rotation out of large cap tech into real economy value. And another way to put it is moving from asset light businesses to asset heavy businesses. And a lot of that's been driven by AI uncertainty. Rotation can be healthy because it broadens leadership, but if it persists too long, it can morph into a topping process where leadership becomes unstable and rallies lose follow through. So, in the next slide here, we're looking at breadth as how it measures stability. And so this is the S&P 500 on the top of the box, and the bottom is the Ned Davis Research High-Low Logic Index. And essentially what you can see here is that when high-low logic is high, it's essentially pointing to a market that's out of gear. And when markets are out of gear, typically returns are muted. So the high-low logic index tracks the lesser of new 52-week highs and new 52-week lows. A high reading will mean that you're getting many highs and many lows all at the same time, which signals a lack of leadership. Historically, the S&P 500 has struggled when the index was elevated, this high-low index. When the index was above 4.1, annualized performance was negative 2.7%. When the index was below 2.5, annualized performance was 22.3%. So if this market stays out of gear and confused, it could cause fundamentals to break. So we're on the lookout of that at this time. Lastly, implication five, the models do remain resilient. So despite all the risk we've discussed, the weight of evidence review remains positive for U.S. stocks as a whole. So Ned Davis has a U.S. asset allocation model, and for the 11th straight month, it's remained positive, overweight. Credit spreads have widened and economic sentiment has worsened, but most trend economic and sentiment indicators still favor stocks over bonds. Here's a couple of indicators that we typically look at. The U.S. stock market model is neutral for the fourth month. The Fab 5 as a leading indicator composite is bullish. It has slipped somewhat neutral recently. Our moving average model is bullish, as well as our crude oil futures as a whole, and that could change if supply changes keep or push oil prices higher. So this slide shows current positioning. If you were to compare this to an index or a baseline risk tolerance, you would be at 60% equities, 35% bonds, 5% cash. That's more of a similar to your baseline index. As of today, our models indicate overweight equity exposure to 68.5%, 31.5% in bonds, and 0% in cash. The submodel summary is also helpful. The stock market model is neutral for a fourth month. The Fab 5 indicator slipped to neutral, but overall, we still see bullish indications. Bottom line is that crisis sell-offs typically recover within weeks unless the economy is damaged materially. Inflation has a buffer before the key CPI signal turns bearish, so we do have some room there. A new Fed chair does add uncertainty, and a protracted conflict could delay easing. Rotation confusion and weak breadth can weigh on market leadership. Even so, the weight of evidence shows that we still favor stocks based on data. It would take more deterioration from those metrics to show a change in stance there. Um, and so, from a fundamental standpoint, we do feel that it's important to be cautious. In the year two of a 4-year cycle, there's typically enhanced volatility mid-year, and this conflict and can lead to more of that. We think it's important that you plan ahead. Obviously, have your buckets for short-term, intermediate, and long-term needs, and that you stay diversified. The biggest thing in times like this is to not make knee-jerk reactions and big moves that could be detrimental to your long-term plan. We'd love to have a conversation with you if you heard something today that you'd like to learn more about. Reach out to your contact firm. With that being said, thank you for listening and have a great day.